Welcome to Real Estate Coaching Radio, starring award-winning real estate coaches and #1 international best-selling authors, Tim and Julie Harris. This is the #1 daily radio show for realtors looking for a no BS, authentic, real-time coaching experience. What's really working in today's market, how to generate more leads, make more money, and have more time for what you love in your life. And now your hosts, Tim and Julie Harris.
3, 2, 1, and we are back. I'm going to start out with letting all of you guys know that more than ever, knowledge equals confidence and ignorance equals fear. And you are awash right now with people trying to feed you misinformation, fake news about housing. So what Julie and I are going to do over the next couple days, and this is really critical that you stay drilled down and focus on these points, is we are going to give you the unequivocal, absolute drilled down facts about what's happening in housing. You need to write these points down, and then that way you can, again, feel confident and not feel fear. And remember, you're going to be tripping across people constantly, consumers, buyers, sellers, everyone you know, who's going to be full of fear because they're reading news headlines and really not knowing how to, really cut through the Mickey Mouse that is so often in the news. And this happens, by the way, really smart people. Julie and I have had many conversations with really smart people over the last, 6 months where they should know better than what they're saying. They're not thinking about what they're saying. All they're doing is they're parroting some headline that they heard someplace, and they're not really drilling down. Like, I'll give you guys a classic one, for example, just to kind of set the stage so you know what we're talking about. Prices are falling. And then they'll essentially think that means values are falling. I know this is confusing, right? Well, here's really what's going on. Yes, a seller is lowering his price. No, that does not mean the seller is losing money on the house. I mean, provided they, bought it a couple of years ago or even 12 months ago. So
That's right.
Even drilling down even further, in your neighborhood, in your community, the headline's going to be, sellers are dropping their prices faster than ever before. Okay, so what? Who cares? They were just being a little, aspirational or greedy. And now what's happening is they're repositioning homes in the market to correctly reflect the market's expectations. Who cares? That's called a normal real estate transaction. Yeah. That's incredibly different, way different than what happened back in 07, 08, where values were actually dropping less than what people paid for the houses.
Less than even what they owed for the house.
That is called a housing collapse. What you're experiencing now is nothing like it. And yet, how many people believe, and how many buyers are actually making decisions on when to purchase because they don't want to catch a falling knife? Or sellers are actually believing, well, I don't want to sell now. The bottom's falling out on the market. The exact opposite is true. So it's your job to be the purveyor of truth. And that's what today's podcast series is about.
Yes, great example there. And they will probably continue to hear that kind of drama. And so that's where we come in. Our job is to educate you, motivate you, and help you to get into action as a result. This next 2 podcasts, today and tomorrow, are going to be heavy on the education end, as Tim said. So get ready to take notes. There will be lots of stats and facts and figures and things like that because we're facting right now. We're not speculating. We're not headlining. We're giving you what is actually going on. I have a lot of research in this. This is not speculative. This is actually what's happening.
It's worth mentioning, Julie, that the people writing the on the CNNs and the CNBCs and the Fox Newses and everyone else, they have access to this exact same information that we're about to present. They choose not to present it.
No, exactly. They choose to either spin it or take a micro point and try and turn it into something that it isn't. So that's why we have to do podcasts like this now and then.
And Julie and I have thought, ever since we saw, 2007, when that really was a legit housing crash, we noticed how quick the headlines went to be anti-housing. And that's always been a little bit of a curious thing. You guys can kind of speculate as to why. Obviously, it's people are clicking on the negative headlines and they're reading the headlines, and thus the news outlets are producing product, and their product is, something that people want to read. There is that. There's the profit motive. But also there's a lot of people out there that don't believe, and frankly, they just want housing to be socialized. And those people always come out of the woodwork anytime there's an economy like this. I remember very clearly back in 07, 08, 09, there were a lot of people that were just basically saying that there should be, in essence, a limit to, private property rights.
I know.
Where there should be some sort of federalized housing where, all this. And that was what people were actually believing, essentially taking away one of the core tenets of our country, which is being able to own property, or, more traditionally, the American dream. So there are all kinds of weird reasons, subversive reasons, if you ask me, why people want to see housing collapse. And you've got to realize that a lot of the people writing these articles too, this is what Julie and I talked about yesterday, writing the articles, writing the headlines, how old are they? They're kids. They're people in their 20s. They have no reference as to the last housing market or really history beyond their own lifespan. And they probably themselves don't make very much money because, turns out being a reporter doesn't pay very well.
I was going to say that. Also, they are not buyers or sellers.
Yeah, because they probably can't afford to buy a home. So they're biased in their reporting. So again, you're going to have to be somebody who is reading news, even this podcast, anything you hear, you got to kind of run it through a skeptical filter. And then once you trust the source and then validate the source is trustworthy, then you can go forth and assume that the information is, something that you can present to other people. But it is incredibly important, more than ever, that you absolutely positively become your own guru, your own expert, your own, essentially someone who you would want to go to listen to with regards to advice and with regards to prognostications as to the future of housing. So without any further delay.
Yes, well put. Thank you for that intro. So what is happening in real estate by the numbers? Again, we're talking facts here. I have fact-checked this up one side and down the other, so no worries here. There are buyer, seller, and investor prospects everywhere, but if you're nervous or awkward about having conversations about real estate, you will miss out on those opportunities. Remember that knowledge equals confidence, ignorance equals fear. Know the talking points so that you can speak with confidence about the market. Stop being a secret agent and you will soon find more people to help buy and sell real estate. Find your conversational confidence. Talk about real estate all the time and soon you will be generating tons of new transactions. So here we are on part one of your talking points, day one, point number one, mortgage rates. That's always a hot topic. Are they up? Are they down or are they stable? Here's the facts. This week, the average annual percentage rate, that's what they state as APR, on a 30-year fixed rate mortgage fell 6 basis points to an average of 6.46%. The average APR on a 15-year fixed rate mortgage fell by 5 basis points to 5.584, according to rates provided by NerdWallet. Okay, and NerdWallet is also tied to Zillow somehow, but I find their facts to be good.
I'm just laughing that you, of course, would visit a website called NerdWallet.
Well, it's my people, right?
Yeah, exactly.
Okay, the 30-year fixed rate mortgage is 11 basis points, and we'll define a basis point in just a second, lower than 1 week ago, so it's coming down, and 120 basis points still higher than 1 year ago. A basis point is 1/100th of 1%, and rates are expressed as an annual percentage rate, again known as APR. So what does this even mean? Again, talking point. Note to self, on a $300,000 30-year mortgage, a 50 basis points increase in the mortgage rate adds about $100 to the monthly payment and about $35,000 to the total interest paid over the life of the loan if it's not refinanced.
And by the way, who stays in the house 30 years?
Or doesn't refinance if the rate's too high, right?
Exactly.
I mean, it's interesting that you bring that up because I think that people get really stuck on the exact rate on, the day that they close. Just because it's called a 30-year mortgage does not mean that you're either going to stay there for 30 years, to your point, or that you're actually locked in for that 30 years. You have lots of options.
Just make sure there's no prepayment penalty on the mortgage, which we haven't seen for years, but sometimes those sneak in.
Yes, that's right. And, mortgage products are changing a lot. A lot of this stuff is coming back. And so it is wise to check for that.
Well, along those lines, Julie, as there will be more banks that fail. The commercial, I know this is one of your points, so I'm not going to step on it. But there is going to be a commercial, I don't want to use the word collapse, but I will anyway because I already said it, for commercial loans, for commercial mortgages that are attached to buildings, mostly office buildings. And this is an interesting little tidbit. So if you go to a lender to buy, I'll just make up something, 100, let's say it's 10-story office building, right? And the 10-story office building has so many offices that collect so much rent every single month. Let's call it a medical building, whatever, right? Sounds like an absolute, and banks have historically treated these types of loans. These things are beyond grade A risk. They're just absolutely locked in. Obviously, this is very little debt or very little risk from the lender's perspective. So lenders love these sort of commercial loans. They have a lot of them. Most lenders have 40% of all their loan portfolios are these types of commercial loans. But here's what's happened. a lot of the space now, in order for the landlords to rent the space, have been lowering the cost per square foot. So like if you're in an office building, and if you guys are commercial, you're going to be able to understand this better than I'm explaining it. But one of the ways they're going to figure out, well, what's the value of the building is they're going to look to see what the average cost per foot is. And one building must be this, it might be this cost per foot, and another might be this, just depending on the amenities and the age and all the rest of it. So if when the borrower, the investor, the landlord, goes to the bank to secure the loan to buy that commercial property, one of the covenants that's almost always written into these commercial mortgages is that the rents cannot be lower than a specific amount. In other words, the value of the building is directly tied to what they can rent it out for every single month. And it's unlike residential housing. It's much more rigid, much more analytical, much more, black and white.
More strict.
Right. If the building is going to be able to rent for this, then it's worth this. If it's renting for lower than that, then guess what? The building's now worth lower than that. That's it. That's how they figure it out. It's very, very, that's it. Analytical. So what you're going to discover are a lot of these mortgages, a lot of the landlords have to lower their rents in order to get the tenants to stay because the market's become too competitive, or just to get the units rented out. And their loans aren't going to permit them to do that. So they're going to be in default of their loans, sometimes even when they're making payments, because they've essentially changed the terms of the mortgage by devaluing the asset that the bank is in essence a partner with. So that's one of the little widgets that you're not going to see, obviously, on the residential side. And that's what's happening in San Francisco. That's what's happening in these major cities. But I'll tell you, this is what Julie and I predict is going to happen. There is zero chance, and I mean zero, that there will not be some sort of government bailout. It just won't happen. There's going to be some kind of government bailout because they cannot, the banking system cannot handle the domino effect of a bunch of banks failing. And these smaller local banks are almost always the ones that are carrying the largest percent of this commercial type debt. So when you hear in the news, and it's starting to, percolate its way into the headlines of every newspaper now, by newspaper I mean website, and you're seeing that they're all talking about the same thing. Now, why am I telling you all this? You guys are residential agents, 99% of you. It's because your consumers are reading these headlines and not realizing when they're talking about a real estate crash or collapse, they're not reading beyond the headline, and they're thinking it means housing. You guys get it?
Yes, because real estate is all one big bucket, right?
Exactly. In people's minds, they don't understand. So
that's true. And a lot of the financial reporting, the more like the stock analysts and guys like that, they just look at real estate as an asset class like they would something else. And so it becomes very confusing unless you pull out these very specific facts. So yes, when you hear, a headline might say 25% vacancy rate. Well, okay, that is downtown Chicago in office buildings, high rises. That is not in your neighborhood. Okay, so point number 2. And point number 2 has a lot to it, but there is a great punchline at the end. So bear with me here. All right, so the next question, of course, would be, what will rates do in the near future? Should a buyer lock in now or roll the dice? You guys are getting this question from your buyer prospects, and many of your buyer prospects are also seller prospects. They have a listing as well. Now, the market now assigns an 85% probability of the Fed hiking rates another 25 basis points. We just talked about what basis points are. That's supposed to happen next week, which is their next meeting coming up. Even though there are two things. One, clear signs inflation is already trending down, and also increasing recession risks are forecast. So here's the saying: a buyer should marry the house and date the rate. Lock in this week's lower rates. Remember, rates came down week over week, but also have a float down feature. For example, a mortgage rate lock float down locks in a rate during the underwriting period, but has an option to reduce it if the market interest rates fall during that period. Remember, some of you guys have pendings for 60 days, 90 days. A lot can happen with interest rates. Borrowers are protected against a rate increase because they locked in at today's rate, while the float down option allows them to take advantage of a rate drop during the lock period. So this is a way to deal with, should I wait, should I lock in or not? Should I roll the dice? Now, this option sometimes comes at a fee, the cost of which depends on the lender. Many mortgage lenders don't charge any fee. It's a USP for them, a unique selling proposition. They advertise, we won't charge you for a float down, but some do. Typically, they charge between 1/4 point, maybe 0.5% of the total loan amount for a rate lock of 60 days or less, and between 0.06 and 0.375 for an extension. So if you get a delay, and I remember this used to happen to us a lot when we were closing lots of transactions, you have a delay. Oh no, they're going to lose their rate. This is a reason that you want to do those extensions. Now, ultimately, a refinance is always a possibility when rates go low enough to affect the payment. Just because a borrower closes today at 6.5 does not mean they have to have that rate forever. So what is the bottom line to handling this question? Remember, objections are questions, right? Should I wait or should I lock in? Homeownership is key to building wealth no matter what the rate is. Check out these facts. As a result of home price appreciation over the last decade.
Inflation.
Yes.
Replace the word appreciation with inflation.
Inflation.
The result's the same.
Yes. And the, quote, forced savings of monthly mortgage payments. The net worth of a typical homeowner is 40 times the net worth of a renter. That's an NAR stat. Net worth is calculated by subtracting liabilities from assets. Homeowners in the U.S. have a median net worth of $255,000, while renters have a net worth of $6,300. That's a difference of 40 times between the two groups. I also got that from MSNBC as well. Now, a recent study done by NAR found that over the last decade, the median-priced home appreciated or inflated by about $190,000. But, of course, that only matters to people who actually own homes.
So you said a few things. I'm sort of curious.
Yes.
This is the first time me hearing and seeing this. I mean, on our podcast, I didn't read our notes prior. Where did the source that was predicting that there was going to be a 50 basis point rate increase, do you remember where that source was?
I think that was through Housing Wire, and that is related to whatever I just said. It was related to bond rates and some other stuff.
Okay, so I bet you there won't be any raise of any rates, and I'll tell you why.
Why?
Because it's political now.
Yeah.
That's why. Because
and the presidential race is on.
That's exactly why.
I hope you're right.
Yeah, there won't be
Or that might be a 1/4 point instead of a 1/2 point too.
Ultimately, what they're trying to do, obviously, is they're trying to slow down the economy. They're trying to slow down the rate of things increasing in price, aka inflation. But really, they can't. At this point, it won't matter. Inflation is here to stay, and in many sectors, it's just going to get worse. And this is just a mega cycle of inflation. We've experienced this before. And they can't raise the rates. This is what's kind of fascinating too, guys. There is no easy button, and I won't say what they did back in 1981 was the easy button when they raised rates to almost 20%. That's what they did. That's how bad things got in terms of inflation. The prices of things were going sky high. Everything, when inflation creeps its way into food prices and everything else, then it really starves people. People start becoming food insecure. There are actual real problems that happen when there's inflation. It's tragic. I mean, it was Venezuela, Julie. This is true, and this is in recent history. The inflation got so bad, people couldn't buy what was in the stores. The stores couldn't replenish their shelves. The stores went out of business. People were starving, and they ate the animals in the zoo.
Yeah, and the strays and the.
Yeah, exactly. That's what happens when there's really bad inflation. Will it happen here? No, it won't happen here. Could it in other countries that aren't as large and prosperous as the United States? It could. But this inflationary cycle, the easy button, quote unquote, air quotes, right, is to raise rates to the point where basically people say, I'm just going to keep my money and I'm not going to spend. Oh, well, that can't happen this time. And here's why. Because the country owes over $30 trillion in debt. And most of that debt is very short-term loans, basically. So you guys should just, if you want to really, dig into this, go to treasurydirect.gov, treasurydirect.gov. You can actually buy a Treasury T-bill right now that'll pay 4 to 5%. That means the government is auctioning off the debt that you will then purchase, and then essentially that's the interest they're going to pay on that. You can do a Treasury T-bill. I looked on Monday, and the actual rate that you could get, Julie, and this was for a 90-day T-bill, you could put it in as little as $100, which was almost 5%.
Yeah, that's staggering.
So that means that the government is going to, if we were to buy that T-bill, the government's going to have to pay us 5% in 90 days. And there's other forms of government debt, too, that even pay more. So the government is having to pay more to get people to want to buy its debt. And when that happens, that means obviously all of the debt that the country has, the $31 trillion, I think it's $3 trillion now, all of that debt, the interest payments on that debt, most of which, again, is not on like long-term 100-year debt cycles. It's very short term. So the interest rate on most of the U.S. debt is increasing like every 90 days, every 6 months. There will be a time, and it is, on the near future, where if they keep raising rates, the interest payments to all the, bondholders, basically, it's going to get to the point where the government is going to have to raise the hell out of taxes, which is basically, that's most likely what they're going to try to do. But how much can you tax people during, an inflationary time like that? Or frankly, they're going to have to cut spending, or both. So is it possible that the government's going to actually start to have to cut spending to all the quote unquote entitlements? I don't know. I mean, what's going to happen when all of a sudden Social Security payments aren't automatically, like my mom, she lives with us. She's 83. Her Social Security goes up with inflation. She just gets an automatic boost in her Social Security. Well, there are a lot of people like my mom who are getting paid a lot of money. And is there some point when that can't be sustainable? I don't know. So this is the problem with this whole idea that the Fed can tame inflation by continuing to raise the rates after all that's worked in the past. It can't work now because the amount of interest payments on the debt. So I don't know what's going to result in this super cycle. Nobody does. And Julie and I are blessed to have some very smart people as friends. And we've asked them about this. Mm-hmm. Most recently, Peter Schiff. We were over his house and we were having this very conversation with him. And you guys know Peter because he's on Fox News. He's on CNBC. He's everywhere. He's kind of like a global economic superstar, basically. And we were having this very conversation and asking him what he thought was ultimately going to happen. And the real question is how long will the world want to continue to fund our debt? And, fortunately, at this point, it doesn't seem like there's ever that people aren't, different sovereigns, different countries. It doesn't seem like they're going to want to stop buying it. So that's good, but there will be a point where the interest rate is going to get so high that it's going to be kind of a scary thing for the ramifications are not small. Which, by the way, if you're looking for great short-term interest rates, definitely look into T-bills. Definitely buy some treasuries.
That's a big trend right now.
Yeah, for sure.
Reading about that as well.
Julie, Apple opened its own damn bank. You know that, right? I told you. So Apple opened its bank. It's partnered with Goldman Sachs, I believe, and their rate is 4.125 or 4.15%
for savings.
Right. You can go and open up a bank, a savings account, and get in the mid fours because the banks have to compete with the treasuries.
Yeah, that's kind of awesome.
Well, it is kind of awesome. So if if you have your money in a bank that's not paying at least in the mid fours, there you go.
So there's a lot of shifting going on right now.
Yep.
Okay, so point number 3, another talking point. Aren't sales way down this year? Lots of headlines saying real estate number of sales, volume of sales has plummeted. Well, they are down, but they're not what you would call way down. Existing home sales last month declined by 2.4% month over month. But the projected total sales volume is still higher than it was at the beginning of the year. The beginning of the year, everybody was worried it was going to be right around 4 million home sales. Now, to compare that, last year I think we were closer to 5. Previous year it was like 5.5. During the first year of COVID, it was closer to 6. So yes, that's down, but it has been steadily creeping up. NAR and other sources project an annualized pace now of 4.440 units this year. So here's the only question you should worry about with regards to this point. How many transactions do you need this year to meet or exceed your goals?
Well, do the math on that. So 4.4 million transactions, let's say, and let's say the average sale price is $425,000. And I don't know what the average commission is. Let's not, let's just assume that there's two sides to it. Let's assume the commission is 6%. So you're now talking about, let's say, $25,000. Each buyer's agent's making 12, the listing agent's making 12. Multiply that times 4.4, right? Yeah. That's a lot.
That should be enough for you guys. I'm just saying. I mean, how many of those are you going to be part of?
So before you start believing there's a lack of opportunity, it's just that you're, frankly, not drilling down and seeing that there's opportunity everywhere. You are smart to be in real estate. You are blessed to be in real estate in this market. Everyone is interested in buying or selling always. You're not selling something that people can just voluntarily choose not to buy anymore. They always have to live someplace. God bless homeless people. You guys get what I'm saying. But the moral of the story is don't be afraid of, or don't believe the misinformation about the housing market. And also, if you're confused about what direction you should be going right now, it should be abundantly clear to all of you to join Premier Coaching. And the best part is we made Premier Coaching free for you to join. You can just click the link in the description of today's show. Just scroll down, read the description, and then there's a link right there you can join. Or you can just go to premiercoaching.com. Or if you'd like, you can just text the word Premier to 47372. But really, any of those three pathways, the easiest way is you're listening on YouTube, you're listening on Spotify, you're listening to us over on YouTube, on iTunes. Wherever you're listening, open up the description, click the link, join Premier Coaching, you're off to the races. Or just go to premiercoaching.com. Yes, that includes, you guys always ask this, there is no upsell, there's no gotcha. Yes, that includes a daily semi-private coaching call with a Harris certified coach. So you, depending on when you join, you're going to obviously have as many as 25 semi-private coaching calls, and you're going to have all kinds of information that you're going to have instant access to. This is the direction you need in this market. This is the reason that Premier Coaching is probably the nation's #1 selling coaching program, and this is the #1 daily podcast because we do give you guys information that's practical, tactical. You listen to this podcast feeling educated, motivated, and then hopefully you're going to get into action. So go to premiercoaching.com or just click the link that's in the description of today's show wherever you happen to be listening to us.
Point number 4, our final point for today's podcast, another talking point, our price is going to crash. This might be the number 1, should have been at the top, but our price is going to crash. Thanks to low inventory and rising demand, the median sales price didn't crash, hasn't crashed. It actually rose month over month. Now it's at about $376,000. You were saying 400. It depends on your market, but somewhere around 400.
You're talking medium versus average. So you said
right.
Medium. The average is 425. The median is 376.
Yeah. So there are places, mostly in the western cities, that have had a decline in average sales price, and that's been about 8 to 10% in San Francisco, San Jose. About 10% lower this year versus last. But I read a report this morning that said that has started to stabilize, and they think that that's going to be the end of that lowering. Now, much of the rest of the country is averaging between 3 and 8% increase year over year, with some areas even higher. Now, how do you know about your own market? Check your own hot sheet to see what's hot and what's not locally. Every market has areas that sell better than others, price ranges, neighborhoods, zip codes. The difference that's developing now is that some homes in your market will sit on the market longer. And by longer, really, we're still talking 45 days or less. And others will still get bidding wars. You have to know your subject property. We're no longer moving in lockstep where you can say, well, my whole town's doing this. No, neighborhoods are different. So drill down before every listing appointment and before writing offers for your buyers. Each subject property has a different pricing profile. Now, one of the reasons, and I didn't get this in my notes because I just read about it yesterday. One of the reasons that we have this whole demand bubble, okay? So it's all a function of supply and demand. We have low inventory, we have high demand. So I heard a statistic that, and this was a Housing Wire one, Gen Z, and Gen X and Gen Z. No, I'm sorry, it's Gen Z and Gen Y. Okay, so the younger than millennials.
Right.
The combination of those two generations is larger than the entire population of Japan.
Yeah.
And they are starting to come up and buy homes now. Especially the Gen Z are starting to buy homes. The Gen Y is a little bit too young. They go down to age 13, so the early 20-somethings are starting to be. Now, why does this matter? Because as of last month,
I think you had it. You had it backwards, but that's okay.
More than 30% of home sales were first-time buyers.
Yep.
Okay, so when you hear the headline, nobody's selling right now because they don't want to break up with their 3.5% interest rate, guess what? First-time buyers don't have that problem, and they're gobbling up a lot of the inventory.
Julie, while you were reading these points, here's where my mind was going. So if the average sale price, not medium, average sale price is $425,000, and let's say somebody puts down, let's say they have a $350,000 mortgage balance. I'm going to challenge you, right?
I don't know off the top of my head without looking.
You know what I'm going to ask you, but what do you reckon the PITI is? The principal, interest, taxes, and insurance is on $350,000. $2,500.
Yeah, I was going to say 26.
Okay, so
depending on their taxes.
Now, I want you listeners listen to what I'm about to present to you, and this is what you got to remember. So, if someone's going to spend $30,000 per year on a house, this does not include maintenance and upkeep. It's just basically the cost of the house. First of all, that house probably would cost that much to rent. I mean, that would be what the payment would be if they're
probably
renting.
Pretty close.
Yeah. But here's the thing that's fascinating. If that house inflates or appreciates by 8%, That house at $425,000, basically their cost of living is free because the house will have inflated, appreciated at a greater, in terms of actual dollar amounts, it will have inflated greater than what they'll actually have paid to live in the house. And that's year after year after year. And by the way, the inflation compounds. So, or rather, the next year's, like say, goes up 8%. That's based on, they bought it at 425 and now it's worth, 432, 440. Now the 8% the following year is based on 440. That's the reason that homeowners are able to actually
accumulate wealth. I mean, call it what it is.
And right now in an inflationary time, if you're feeling fear, in an inflationary time, real estate assets, things that actually go up because of the fact of, all the things you guys are experiencing right now in life, that's how you make the money. I mean, I believe it was Baron von Rothschild, and this is forever ago, but he said he meant this literally, and I'm not meaning this literally, but he said when there's blood on the streets, buy real estate. And that meant when there's the absolute unraveling of society, buy real estate because nobody else is going to buy it. And I'm hearing other people now say similar things, like all these Bitcoin, gold types and whatever. They're all saying buy real estate, buy real estate. Of course, you're going to buy real estate.
That's called demand.
Exactly. And if inflation is going to drive, now let's just say we're in this long-term inflationary cycle, as frankly we believe, and many other people believe as well, where you're going to be looking at, say, 6%, 8%, something like, every year the homes are going to appreciate or inflate by that amount. Where's that $400,000 house going to be in 10 years? Do the math. Take $400,000 right now. We're not going to do it for you. And then add 8% and do that, add 8% to whatever that the new number is. Do it 10 times. I'll tell you, just off the top of my head, that house is going to be worth, you guys can check me on this and put it in comments. I'm just doing it in my head. I think $1.1 million. So in 10 years, that house will more than double in value. And you're talking about a homeowner then who will have at least, $600,000 in equity, not to mention what the money they put down and paid down towards the mortgage. You guys get it?
But you wouldn't want to close at 6.5% today.
Exactly.
Oh, we're going to focus on that instead. And you know what else that cracks me up? Okay, this is just so, I don't know. I guess it irks me in some way. There were so many people for so long, and you guys know it because you were doing these deals. How many deals did you do in the past 3, 5, even 10 years where the buyer was willing to pay over appraisal by $10,000, $50,000, sometimes $100,000, and the higher end even more than that? They were happy to part with that. What does that equate to in $100 more a month because the rates went up? If you're a $350,000 borrower, right? So how is it that they were willing to throw money at it like that and literally overpay by saying, I will close the appraisal gap? And yet they're so resistant to a couple $100 more or $500 per month. It's because they don't think about it the same way.
I honestly don't think what you're saying is accurate. I don't think there's that perception amongst consumers. I think that's just the headlines that are trying to make people think that's
definitely
the truth.
More than
people
because, actually closing, certainly.
Because here's why.
Yeah.
When you put a home for sale, even if the prevailing rates are 6.5%, we don't have an interest rate problem. We have an inventory problem.
Absolutely, 100%.
If you want to
that's one of tomorrow's points.
But that's the bottom line.
Yeah.
There's not an interest rate problem. And I don't think, frankly, there would be that much of an interest rate problem. The reason that the market slowed down when the interest rates were at 8%, it was, frankly, because people were just the change. It happened so fast. Yeah. There was fear. And
temporary shock.
Right. When people feel fear, they do nothing. They go to ground, right? They go to their caves and they block the entrance off and just wait for the storm clouds to clear. Yeah. That's what people always do. There is an inventory problem. There's a lack of homes for sale. You put real estate for sale, even with interest rates at 6.5%, people are going to figure it the hell out, especially if they're moving out of a house that they're able to put down 50% into the new mortgage. They don't care what their rate is. Who cares?
No, and further to your point, okay, so I'm with you. I just think it's interesting that we were throwing money at appraisals for so long. So the other thing, and I have to look up the stat for tomorrow's show, it is a certain price range on average that goes also with an age range. And I think it's right around 45 years old and your third house where you stop financing for the most part. Mm-hmm. You just, it's not an issue for you. You're either going to downsize and pay cash or you're going to upsize and you have accumulated enough because of how real estate works that you're, again, either going to have a significant down payment or you're going to pay cash. So again, the whole rate sensitive thing, I think you're right, is less of reality and more of a headline.
And, you know, Julie, you said this a second ago, there are a lot of people out there that have super low rates. And they're probably going to, if they're money minded, they're going to sit on those mortgages and they're going to let the inflation pay the house off over time. You know, it's free money. But most people don't think like that. Most of you don't think like that. You're going to say, I want a new house. I need the more space. I want to be closer to this or further away from that. And then you're going to sell your house, even if it has a 3% interest rate. And then you're going to walk into another one that even has a 6.5% interest rate. But you're going to walk into that having, sold your last house and maybe walked away with $200,000-$300,000 because you bought it at the right time because of inflation. And the payment's not going to be that much different than it was when the interest rates were lower because of the fact you put so much more money down.
That's right. And also the house that you bought that was more expensive, when it goes up by X% every year, that's based on a higher price. Thus, you are building more equity.
Right, exactly.
You know, there's that, right?
That's the cool thing about real estate. One of the many, many amazing things. And you guys are in the right place at the right time in the right market, provided you have the right information. And then when you're at, Orange Theory, hopefully, or you're one of these other places and you're having conversations about real estate and the people probably just listen to a bunch of garbage news on the way over to the, workout, you're going to be able to hit them across the head nicely with a Nerf bat with facts.
A housing Nerf bat.
They're going to love talking to you because you're not an idiot. You're giving them the truth. This is what gives you confidence. And when you're able to talk with confidence about facts, then what happens? They want to do deals with you. They want to do business with you. They will immediately, you want to know what makes you special? It's when you actually have done the work to provide information to people that they then put value on. So they're talking to you and you're, facting them. And then they talk to somebody else who also has a real estate license. And that person's just spouting something that they heard on CNN. You guys get the point? Just remember, there always are people that want housing to fail. There are people that, for whatever their agendas are, whatever their motivations are, you've got to filter that information. You've got to realize most of the information being provided it's not real facts. Are people's opinions loosely based on facts? And then, well, why is your opinion that way? Why do you think everyone? Like, here's another trend that's going to start. Mark my word. We're going to start talking about micro homes again. We're going to start talking about people living in 400 or 500 square feet. That's going to be a thing. And they're going to say, well, why don't we just, take these big fields of these, former shopping malls, knock the buildings down and put in 12 billion of these little micro homes. That's called a trailer park, guys.
Right.
Okay, nothing wrong with trailer parks, but that's called a trailer park.
Not a new idea.
Right, exactly. They're trying to say a micro home. Oh, here's what it's going to look like. It's going to be a rectangle. It's going to have these really cool things and really cool lights and windows and the rest of it. You're describing a trailer. That's what you're describing. These are not new ideas.
This is true.
So anyway,
it's just a spin, as always.
It is. So, guys, pay attention to the facts. Apply the facts. Help people to then make informed decisions. And you will find yourself, doing more of those transactions of the 4.4 million that are projected to happen in the next 12 months you can possibly imagine. In the meantime, do the right thing. Give us a 5-star review on iTunes. Not a 4-star. Come on. Give us a 5-star and include a pithy comment. If you're over on YouTube, please do subscribe, leave a comment. That's great as well. Thank you for getting our YouTube. We have now over, I didn't tell you, did I? We have over 20,000 subscribers on YouTube. The podcast is still over this year so far. It's had it's like almost 2 million downloads and listens. So we are, I think because of the fact that we're giving you guys non-fluff information and you're walking away from this podcast feeling frankly motivated and confident and educated, this podcast continues to be one of the, if not the number one source, especially on digital for, real estate agents. Number one podcast, and it's, we could even become the number one podcast internationally for real estate agents, which is pretty cool. Yeah. So in the meantime, guys, thank you. We're going to pick up tomorrow where we left off today. Have a fantastic day.
This podcast is a part of the C-Suite Radio Network. For more top business podcasts, visit c-suiteradio.com.